As we look at large tech earnings, we got to look, as I mentioned, at the Dow today, which is seeing more under pressure here. And as fourth quarter earnings are rolling in, our first guest today is not very optimistic about forward guidance this year. Let's welcome in Eric Sterner of Apollon Wealth Management CIO. So, Eric, we've been talking about that, big tech is sort of still pulling the market along. But why are you not as confident about the outlooks we're going to get more broadly from companies?
Yeah, well, thanks for having me on the show. And I think there's a lot to be positive about and optimistic about in the market. But right now it's just priced for perfection. It's priced for everything to go right, between the market jumping ahead from the latest Fed meeting and pricing in 6 rate cuts to 12% corporate earnings growth. And we just saw last quarter, analysts all the time, they'll downgrade or decrease their earnings per share estimates. But last quarter, they decreased them by 6.8%, which is more than double the 10-year average at 3.3%. So analysts are really starting to pull back. And I think we're just starting to feel the full effects of all these rate hikes. We know the economy is slowing down. We know consumer spending is slowing down, and labor costs are higher. So while I am optimistic on the market, I think it's getting a little ahead of itself, and I'll be anxious to hear some of that forward guidance in this earnings season amongst the S&P 500 companies.
And Eric, I'm also interested, we were talking not so long ago about, kind of these bets that the rally would broaden. Instead, I don't know if you heard, I was talking to Julie, we're right back to talking about the Magnificent Seven again, Eric. I'm just wondering, does that surprise you? And do you see that changing in the quarters ahead?
Well, it certainly feels a lot like 2023, right? And I think when you have that narrow breadth, it certainly adds some risks to the markets. So I know, coming out of the last year, those last 2 months, it was an everything rally where every asset class, every sector seemed to rally. And now I think as investors are digesting news, the good news that we're seeing the economy continue to stay afloat, but that may push back the rate cuts. That may keep it higher for longer. And the bad news of potentially, the recession is not out of the question. I think investors just flock back to the Magnificent Seven, knowing that worked last year. Those are quality companies, solid balance sheets, solid earnings. So I think investors are just waiting to hear and get some more guidance on some of these other sectors. I think there's a lot of great opportunity there. Obviously, the valuations on technology, consumer discretionary communications are at historical highs, which really put more downside pressure. So I think there is more opportunity in the more value-oriented sectors, such as financials and energies, which are very cheap by historical standards right now. And those have typically solid earnings amongst companies within those two sectors.
Well, and as you sort of alluded to, Eric, pretty soon here, we're going to be out of earnings season and into Fed watch season again, right? We sort of take a brief breather during earnings from that laser-like focus on that. Those groups that you mentioned, are they ones that can benefit as the Fed starts to cut here? And, the market seemed to be really obsessing over the timing and the number. Are you as focused on that particular issue?
No, I think what I'm excited about is I think this year we're really going to get back to the fundamentals and determining the best investment options, because we know there's an extremely high probability the Fed is done raising rates. So whether I don't think they're going to cut rates in March. It's probably going to happen in the summer. Whether it's May or June, obviously doesn't really make a big difference. But I think those sectors that I mentioned between energy and financials, yes, absolutely could benefit from those rate cuts. And I think there's certainly some banks, we know the regional banks were under tremendous stress with those rapid series of rate cuts. But within other industries, within financials, such as insurance companies, they really benefit. That helps their profit margins with these higher rates. And we know that we don't know where the Fed will stop as far as the rate cuts and how long they'll be cutting. But I think that it's safe to say that interest rates are going to be higher than what we were used to the past 20 years, where we were living in an ultra low interest rate environment. The world has changed a lot in the last few years between the geopolitical tensions and the backpedaling of globalization. So I think that's just going to keep some more upward pressure on inflation, keep those interest rates higher than what we've been used to over the past 20 years. And that could benefit companies within the financial sector.
And Eric, I want to get you out of here on this, ask your insight into another variable here we have to consider, which is the election. You saw the news out of that New Hampshire primary. I'm just interested, Eric, how much your clients asking you about that? Is that top of mind for them? And when they do ask you about that, what do you tell them here?
Yeah, it's going to be an interesting year. Typically, historically, stocks have done well during election years, but we know this election can be very polarizing. So I think there's a lot can happen between now and November, as we know. So I don't think it's while we do have some questions coming in. I think those questions will increase as we get closer to the election cycle. We know that if Trump were to come back into the presidency, that could cut back immigration, that could increase tariffs, and which in turn, both of those could be upward pressures on inflation, and we could recreate the problem right there with just a few items in the back of our heads as we talk about whether a Biden re-election or a Trump returning to the presidency could mean to the economy. But I think it is too early to tell, but it's something obviously we'll be paying close attention to throughout 2024.
Eric, I agree with you. It's going to be an interesting year. I think that's about all we can bet on at this point. Thank you so much, Eric, for joining the show today. Appreciate it.
Thank you for having me.